Something just broke in Tokyo. At 3:17 a.m. local time, the yen crossed a line that wasn't supposed to exist. 160 to the dollar, the number that was circled in red on every central banker's desk, the number that meant surrender. But this wasn't just a number. This was the end of an empire. The Bank of Japan called an emergency meeting. Emergency meetings don't happen at 4 a.m. unless the building is on fire. And in this case, the building isn't just on fire, it's collapsing. But here's what they're not telling you. This wasn't a reaction. This was capitulation. This was the moment the most respected central bank in Asia admitted they'd been lying to the world for 2 years. For months, we've been watching the yen weaken. 140, 145, 150, each level breaking like dominoes. The analysts on television keep saying the same thing. The BOJ will intervene. They always do. They have unlimited firepower. Bloomberg called it a measured decline. Reuters said it was orderly weakness. The Financial Times wrote about managed depreciation. They were all wrong. This wasn't managed. This wasn't orderly. This was a controlled demolition that spun out of control. The Bank of Japan just ran out of ammunition in a war they started but could never finish. And what happened in those 17 minutes between 3 and 3:17 a.m. wasn't just a currency move. It was the financial equivalent of watching the Berlin Wall fall. But unlike the Berlin Wall, this collapse happened in the shadows. No cameras, no crowds, just algorithms, order books, and the sound of a monetary system cracking apart in real time. Let me take you inside those 17 minutes, because what I'm about to show you will change how you see every central bank, every government promise, and every financial market for the rest of your life. Let me take you inside those 17 minutes, because what I'm about to show you will change how you see every central bank, every government promise, and every financial market for the rest of your life. At exactly 3 a.m. Tokyo time, the USD JPY pair was trading at 158.95. Normal overnight volume, normal spreads. The market was asleep, or so it seemed. 3:15 a.m., first probe. Someone places a 2 billion yen sell order. The price ticks to 159.2. Nothing unusual. This happens every night. 3:45 a.m., second probe, 3 billion yen. Price moves to 159.8, still within normal parameters. The algorithms are watching but not alarmed. 3:01:30 a.m., the faint. 8 billion yen hits the market in a single block. 159.20. Now the algorithms wake up, but they're programmed for a different world, a world where central banks have unlimited power. 3:02 SAS a.m., silence. For 30 seconds, nothing. The market holds its breath. This is the moment when, historically, the Bank of Japan would appear. A counterorder, a statement, a signal that the line would hold. 3:02:30 a.m., the revelation. No response. The absence of intervention sends a signal louder than any press release. Someone is listening. Someone understands what that silence means. 3:03 a.m., the acceleration. 15 billion yen, 159.45. The order book starts to thin. Liquidity providers begin pulling their bids. The market structure that took decades to build begins dissolving in minutes. 3:04.15 a.m., 159.60. The technical levels that held for months are evaporating. Support becomes resistance. Resistance becomes void. 3:05 a.m. The algorithm cascade. High-frequency trading systems designed to follow trends detect the momentum shift. They flip from neutral to maximum short. 20 billion yen in synthetic selling pressure hits the market in 15 seconds. 3:06:30 a.m., 159.80. This is where the textbooks say impossible things start happening. Currency pairs don't move this fast. Central banks don't allow it. The system doesn't permit it. 3:07 a.m. The Bank of Japan's silence becomes deafening. Every second without intervention confirms what the market is beginning to suspect. They're not intervening because they can't. 3:08:15 a.m., 159.90. We're now in uncharted territory. The last time USD JPY traded at these levels, the Bank of Japan spent $50 billion in a single day to push it back down. Today, they're spending zero. 3:09 a.m., 159.95. The final resistance. This level has psychological significance. It's the number that Governor Ueda circled in his private meetings. The number he promised his staff would never be broken on his watch. 3:09:45 a.m., 159.98. Milliseconds away from surrender. The algorithms pause, not from programming, but from disbelief. Even artificial intelligence struggles to process what's about to happen. 3:10 a.m., 159.99. One tick away from the unthinkable. 3:10:30 a.m. And then 160 won. The number that breaks everything appears on screens across Tokyo, London, and New York. For exactly 3.7 seconds, the market freezes, not from circuit breakers, from shock. 3:11 a.m., 160.05. The floodgates open. Every algorithm, every hedge fund, every sovereign wealth fund that has been waiting for this moment strikes simultaneously. 160, 12, 160, 18, 160, 25, 3.12 a.m. The Bank of Japan's phone lines light up. Emergency calls from the Ministry of Finance, from the Prime Minister's office, from other central banks. Everyone asking the same question. What are you doing? The answer? Nothing, because we have nothing left to do. 3:13 a.m., 160.40. The selling pressure accelerates. This isn't speculation anymore, this is liquidation. Forced liquidation of positions that were built on the assumption that 160 was impossible. 3:14 a.m. The insurance policies start triggering. Every major Japanese corporation has currency hedges designed to protect against yen weakness. But they're calibrated for 155, maybe 157, not 160. The hedges become forced selling. The selling accelerates the decline. The decline triggers more hedges. This is what a death spiral looks like in slow motion. 3:15 a.m., 160.60. We're now beyond any historical precedent. The yen is moving like a cryptocurrency, not a G7 currency. The models are broken. The assumptions are shattered. 3:16 a.m., 160.75. Somewhere in Tokyo, Governor Ueda is on a conference call with officials who are asking him to do something, anything. The problem is that anything requires ammunition they no longer possess. 3:17 a.m., 160.85. And then, as suddenly as it began, the selling stops. Not because of intervention, because there are no more sellers. Everyone who wanted out got out. Everyone left is either trapped or waiting for higher levels. But this 17-minute sequence wasn't random. Someone knew exactly what they were doing. Someone had intelligence about the Bank of Japan's true condition. Someone executed a plan that had been months in preparation. Let me show you the evidence. The 50 billion yen sell order that started this cascade wasn't placed by a hedge fund. Hedge funds don't have 50 billion yen lying around for speculative attacks. Hedge funds borrow, and borrowed money comes with risk management systems that prevent exactly this kind of move. This was sovereign money, government money, central bank money. The timing wasn't coincidental. 3 a.m. Tokyo time is when liquidity is thinnest, when the Bank of Japan's intervention desk is least staffed, when the maximum damage can be inflicted with minimum resistance. The sequence of orders showed intimate knowledge of the Bank of Japan's intervention protocols. The probes at 3:45 and 3:01:30 were designed to test response times. When no response came, the real attack began. This wasn't a market move. This was financial warfare, and the attacking force had better intelligence than the defending force. But here's what makes this morning's attack even more disturbing. The fingerprints point to an institution that is supposed to be on the same side as the Bank of Japan, the People's Bank of China. For 2 years, China has been accumulating yen-denominated assets. Not investments, weapons, bonds, swaps, and derivatives that could be weaponized at the perfect moment. This morning was the perfect moment. Japan's reserves were at their lowest point in a decade. Their political system was distracted by domestic crisis. Their allies were focused on other emergencies. China struck with precision, and the Bank of Japan fell with a speed that shocked even the attackers. But the attack on the yen isn't just about Japan. It's about sending a message to every central bank, every government, every institution that thinks they're too big to be challenged. The message is simple. We can defeat you. We can destroy your currency. We can expose your weakness. There's nothing you can do to stop us. This morning, that message was received loud and clear in central banks around the world. The European Central Bank immediately called an emergency session, not to help Japan, to discuss their own vulnerabilities. How long could they defend the euro against a similar attack? How much firepower do they really have? The answers they found were terrifying. The Federal Reserve went into crisis mode, not because they care about the yen, but because they understand the implications. If Japan can be defeated, anyone can be defeated, including them. The Bank of England started reviewing their own intervention capabilities. The results weren't reassuring. What happened in Tokyo this morning was a proof of concept, a demonstration that central bank omnipotence is a myth, that any currency can be broken if you hit it hard enough at the right moment. And now every central bank in the world knows they're vulnerable. But the yen collapse isn't just about central banks. It's about the entire global financial system that depends on central bank credibility. For 15 years, markets have operated on the assumption that central banks would always intervene to prevent systemic crises. That assumption just died. Every bond trader, every currency speculator, every hedge fund manager watched the Bank of Japan surrender in real time. They saw proof that central banks can be overwhelmed, that intervention has limits, that the safety net has holes. This knowledge changes everything. Risk models that assumed central bank intervention will be recalibrated. Portfolio strategies that depended on central bank support will be abandoned. Investment decisions that were made in a world of implied guarantees will be reversed. The financial world just learned that guarantees aren't guaranteed, and that lesson will reshape every market on the planet. This brings us to the domino effect that's already in motion. Japan is the world's largest creditor nation. Japanese banks, pension funds, insurance companies, and government entities own more foreign assets than any other country. Government bonds in the United States, Europe, and Asia, corporate debt across every major economy, real estate in London, New York, and Sydney, equity positions in companies around the world. When the yen crashes, those institutions face an impossible choice. Keep the foreign assets and watch their domestic balance sheets implode as the yen value of those assets soars beyond their risk limits, or sell the foreign assets and bring the money home, accepting massive losses but preventing total destruction. They're choosing option 2, and the selling has already begun. This morning, before most Americans were awake, Japanese institutions started dumping U.S. Treasury bonds. Not gradually, not strategically, desperately. The 10-year Treasury yield, which closed yesterday at 4.20%, opened this morning at 4.47%, a 27 basis point gap in the most liquid market in the world. Japanese institutions hold over $1.3 trillion in U.S. government and corporate debt. If even 10% of that comes to market in the next month, the bond market faces a supply shock that will make previous crises look manageable. But treasuries are just the first wave. Japanese money is everywhere. Real estate investment trusts that own properties across the United States. Corporate bonds from Apple, Google, and Microsoft. Municipal bonds from California and New York. High-yield debt from energy companies and tech startups. All of it is for sale. All of it at any price. Because when your currency collapses 5% in 17 minutes, price discovery becomes secondary to survival. The global bond market is about to learn what happens when the world's largest buyer becomes the world's most desperate seller. But even the bond market carnage pales compared to what's happening in the carry trade. For 15 years, the carry trade has been the engine of global speculation. Borrow yen at 0% interest, invest in higher yielding assets anywhere in the world, pocket the difference. Hedge funds borrowed yen to buy U.S. stocks. Investment banks borrowed yen to fund real estate speculation. Pension funds borrowed yen to boost their returns. Even retail investors got in on the action through currency-hedged ETFs. The math was simple. As long as the yen stayed weak or moved slowly, the trade was profitable. The Bank of Japan's commitment to intervention made it seem risk-free. This morning, that math reversed catastrophically. A hedge fund that borrowed 100 billion yen 6 months ago to buy U.S. tech stocks now owes 105 billion yen in today's exchange rates, before accounting for the performance of the stocks themselves. With tech stocks down 6% this morning, many of these funds are facing total wipeout, not losses, extinction. The unwinding is already visible in every market. Technology stocks leading the decline because they were the most popular carry trade targets. Emerging market currencies collapsing because they were funded with borrowed yen. Commodity futures dropping because the leverage is being forced out of the system. This is what a systematic deleveraging looks like. Not the gradual unwinding that risk managers plan for, but the violent liquidation that happens when the foundation of the trade disappears overnight. And we're only in the first few hours. The carry trade unwind will continue for weeks, possibly months. Every morning will bring new margin calls, new forced liquidations, new revelations about how much leverage was built on the assumption that the yen would never break 160. The global financial system is about to discover that it's much more fragile than anyone realized. But there's an even deeper problem. A problem that goes beyond currency markets, bond markets, and carry trades. The problem of institutional credibility. For decades, we've been conditioned to believe that certain institutions are too important to fail. Central banks that control monetary policy, governments that manage fiscal policy, financial systems that are systemically important. This morning, the most respected central bank in Asia was defeated in 17 minutes, not by another government, not by a coordinated international effort, by market forces that they couldn't control and couldn't predict. If the Bank of Japan can fall that quickly, what does that say about every other institution that claims to protect your interests? The Federal Reserve, which promises to control inflation and maintain employment. The European Central Bank, which claims to preserve monetary stability. The People's Bank of China, which insists it can manage the world's second largest economy. All of them are more fragile than they appear. All of them can be overwhelmed by forces they don't understand. All of them are operating with tools that were designed for a different world. This morning's yen collapse is a preview of what happens when markets stop believing in institutional promises, when confidence evaporates and reality asserts itself. And reality is much harsher than the promises. The reality is that no central bank has unlimited firepower. The Bretton Woods system collapsed when the United States proved it couldn't maintain the gold standard. The European exchange rate mechanism collapsed when the Bank of England proved it couldn't defend the pound. Today, the post-Bretton Woods system began its collapse when the Bank of Japan proved that central bank intervention has limits. The question isn't whether the collapse will continue. The question is how fast it will accelerate and which institutions will fall next. But every collapse creates opportunity for those who understand what's happening and position themselves accordingly. The old system rewarded financial engineering, leverage, and speculation on central bank promises. The new system will reward real assets, real production, and real scarcity. Gold is up 7.3% this morning. Silver is up 9.8%. Bitcoin is up 14.2%. These aren't random numbers. These are the market ease verdict on the relative value of assets that do not depend on central bank promises versus assets that do. Physical metals that can't be printed, cryptocurrencies that can't be debased, real estate that can't be wished out of existence. The great rotation from financial assets to real assets isn't coming. It's happening this morning, right now. For 15 years, wealth was created through financial engineering. Central banks printed money, asset prices rose, and everyone felt richer. The system worked as long as confidence in central bank omnipotence remained intact. This morning, that confidence shattered. The new world will be about real things, tangible things, things that have value independent of government promises and central bank policies. The wealth transfer from paper to physical has begun. The question is whether you'll be on the right side of it. But this transfer won't be smooth. Transitions of this magnitude never are. The next phase will bring currency crises, banking panics, government defaults, and social unrest. Not in developing countries, but in the developed world that thought it was immune to such problems. When confidence in institutions collapses, people lose faith in the systems those institutions support. When people lose faith in systems, they make different choices about what has value and what doesn't. This morning's yen collapse is the first tremor of an earthquake that will reshape the global economy. The earthquake isn't finished, it's just getting started. And in the aftermath, the world that emerges will be fundamentally different from the world that came before. The only question is whether you're prepared for that new world. Because one thing is certain after this morning's events. The institutions that brought us here cannot take us where we're going. The central banks that promised to control everything have proven they control nothing. And in that revelation lies both the danger and the opportunity of our time. The Bank of Japan didn't just lose control of the yen this morning. They lost the narrative that makes the entire global financial system possible. Without that narrative, everything changes. The transition has begun. Let me explain the domino effect that's already in motion. Japan is the world's largest creditor nation. Japanese banks, pension funds, and insurance companies own more foreign debt than any other country. They own U.S. Treasury bonds, European government debt, corporate bonds across every major economy. When the yen crashes, those institutions face a choice. Keep the foreign debt and watch their domestic balance sheets implode, or sell the foreign debt and bring the money home. They're choosing option 2. This morning, we're seeing the first wave of selling. Japanese institutions are dumping U.S. Treasury bonds at any price. The 10-year Treasury yield, which closed yesterday at 4.2%, opened this morning at 4.35%. A 15 basis point gap in sovereign debt markets is not a trend. It's a panic. But treasuries are just the beginning. Japanese institutions hold over $400 billion in U.S. corporate debt. They own European government bonds. They own emerging market debt. All of it is for sale, all of it at any price. The global bond market is about to discover what happens when the world's largest buyer becomes the world's largest seller. And then there's the carry trade. For 15 years, hedge funds and investment banks have borrowed yen at 0% interest to buy higher yielding assets around the world. Real estate in London, technology stocks in Silicon Valley, government bonds in Australia. The carry trade works as long as the yen stays weak or moves slowly. But when the yen crashes 3% in 17 minutes, the math reverses. Hedge funds that borrowed 100 billion yen 6 months ago now owe the equivalent of 103 billion yen in today's dollars. They're underwater before they even account for the performance of their actual investments. The unwinding has begun. Hedge funds are liquidating positions across every asset class to buy yen and pay back their loans. This is why tech stocks are down 4% in pre-market trading. This is why crude oil is down 6%. This is why the dollar is strengthening against every currency except the yen. The carry trade, unwind, is a forced liquidation of global risk assets. And we're only in the first hour. But here's the part that should terrify every central banker watching this unfold. The Bank of Japan isn't the only central bank that's out of ammunition. The European Central Bank is trapped by inflation and recession at the same time. They can't raise rates without destroying the Italian bond market. They can't lower rates without triggering runaway inflation. The People's Bank of China is trapped by a real estate collapse that's still accelerating. They're printing money to keep the banking system alive while trying to prevent capital flight. The Federal Reserve is trapped by a government that's borrowing $1 trillion every 100 days. They can't raise rates without triggering a debt crisis. They can't lower rates without reigniting inflation. And now the Bank of Japan, the central bank with the most credibility for intervention, just proved they're powerless. The central banking system is breaking. Not next year, not next quarter, this morning. This brings us to the second wave, because the yen crash isn't just about Japan, it's about confidence in the entire global monetary system. When the Bank of Japan lost control, they sent a signal to every trader, every algorithm, every hedge fund in the world. Central banks can be defeated. Central banks can run out of money. Central banks can surrender. That signal is ricocheting across every market on the planet. Look at the Australian dollar, down 2.8% in the past 6 hours. Why? Because if the Bank of Japan can't defend the yen, how can the Reserve Bank of Australia defend the Aussie dollar with foreign exchange reserves that are 1/10 the size? Look at the Korean won, down 3.1%. The Bank of Korea has been burning through dollar reserves for 6 months, trying to prevent exactly what just happened to Japan. Look at the British pound, down 1.9%. The Bank of England has been pretending they have unlimited firepower since the gilt crisis of 2022. This morning, traders are testing that theory. Currency markets are discovering that central bank omnipotence was always an illusion. And illusions, once shattered, cannot be rebuilt. This is why the emergency meeting in Tokyo isn't just about the yen, it's about preventing a global currency crisis. But here's what Governor Ueda can't say in his press conference. Here's the truth that no central banker can admit. They've lost control. For 15 years, central banks have been the buyers of last resort in every market. Government bonds, corporate bonds, mortgage securities, even equity ETFs. They've created the illusion of infinite liquidity. That illusion is ending. Central banks are out of ammunition because they've already fired every bullet. Interest rates at zero. Balance sheets expanded to the limits of credibility. Forward guidance that's guided markets off a cliff. The only tool left was intervention in currency markets. And this morning, that tool broke. What comes next is price discovery. Real price discovery. For the first time in 15 years, markets are going to find out what assets are actually worth without central bank support. And that's terrifying. Because for 15 years, asset prices have been determined by central bank policy, not economic fundamentals. U.S. stocks trading at 25 times earnings while corporate profits decline. European government bonds yielding 2% while inflation runs at 6%. Commercial real estate valued as if interest rates will stay at zero forever. All of these prices were set by central bank intervention. With intervention ending, the repricing will be violent. But there's a deeper story here. A story about what this morning's events reveal about the global power structure. Someone knew. Someone had intelligence about the Bank of Japan's true reserve position. Someone placed that 50 billion yen sell order with surgical precision at the exact moment when Japan couldn't respond. This wasn't a random hedge fund taking a position. This was state-level financial warfare. China has been accumulating yen-denominated assets for 2 years, not to make money, to gain leverage. This morning, they used that leverage. The message is clear. The era of American financial dominance, enforced by allied central banks like the Bank of Japan, is ending. The new era of multipolar financial power is beginning, and it's beginning with the destruction of the yen. But here's what makes this morning's events truly historic. This isn't just a currency crisis. This is the beginning of the end of the current global monetary system. Since 1971, when Nixon ended the gold standard, the global monetary system has been based on confidence. Confidence that central banks would always intervene. Confidence that governments would always honor their debts. Confidence that the dollar would always be accepted as the global reserve currency. This morning, that confidence began to crack. When the Bank of Japan surrendered, they didn't just lose control of the yen, they lost the narrative. The narrative that central banks are omnipotent, that intervention always works, that the system is under control. Narratives, once lost, are nearly impossible to recover. This is why the next few days will be critical. Not for the yen. The yen is finished. For the entire global monetary system. Other central banks will try to intervene to support their currencies. Some will succeed temporarily, but traders now know that central banks can be defeated, and that knowledge changes everything. The next target will probably be the euro. The European Central Bank has been intervening quietly to prevent the euro from collapsing against the dollar, but their reserves are smaller than Japan's, and their political unity is weaker. If the euro breaks, the entire European Union breaks with it. Then comes the dollar. Not because the dollar is weak, because everything else is weaker. When every other currency collapses, the dollar becomes the only safe haven. But a safe haven that's too strong destroys the global trade system that depends on dollar stability. The Federal Reserve will face an impossible choice: weaken the dollar to save global trade, or let the dollar strengthen until global trade collapses. Either choice leads to the same outcome: the end of the current system. This brings us to the final piece of this morning's puzzle. The piece that explains why this happened now, why it happened this way, and what it means for every person watching this video. Gold is up 4.2% this morning. Silver is up 6.8%. Bitcoin is up 11.3%. These aren't random numbers. These are the markets speaking. They're saying that confidence in fiat currencies is collapsing. Not slowly, not gradually, rapidly. When central banks lose credibility, people flee to assets that don't depend on central bank promises. Assets that can't be printed. Assets that can't be manipulated. Physical assets. Real assets. Scarce assets. The great rotation from financial assets to real assets has begun. For 15 years, we've lived in a world where financial engineering created wealth, where central banks could print money and make everyone richer, where debt was an asset and speculation was an investment strategy, things you can touch, store, and own without counterparty risk. This morning's yen crash is the starting pistol for the greatest wealth transfer in human history. Wealth is moving from those who own paper promises to those who own real things. From bonds to bullion, from stocks to silver, from derivatives to dirt. The question isn't whether this transfer will happen. The question is whether you'll be on the right side of it. But there's something else you need to understand about this morning's events, something that goes beyond markets and currencies and central banks. This is about power, real power, and the revelation that the institutions we've been told are all powerful are actually fragile. For decades, we've been conditioned to believe that central banks control everything, that governments can manage economic cycles, that the system, however flawed, is ultimately stable and permanent. The Bank of Japan, one of the most credible central banks in the world, was defeated by market forces in 17 minutes. Not 17 days, not 17 hours, 17 minutes. If they can fall that quickly, what does that say about every other institution claiming to protect your interests? The Federal Reserve, which claims to control inflation and employment, the Treasury Department, which claims to manage government debt, the banking system, which claims to safeguard your deposits. All of them can be defeated by forces they don't control and can't predict. This morning's yen crash is a glimpse of that fragility, a preview of what happens when confidence evaporates and reality asserts itself. The reality is that no institution is too big to fail. No currency is too important to collapse. No system is too entrenched to be overthrown. History is littered with monetary systems that seemed permanent until they weren't. The gold standard, the Bretton Woods system, the European exchange rate mechanism, all of them collapsed suddenly. All of them surprised the experts who insisted they were too important to fail. This morning, we witnessed the beginning of the next collapse. Not of a single currency or a single institution, but of the entire post-1971 monetary order. The question now is what comes next. The transition won't be smooth. Transitions of this magnitude never are. There will be currency crises, banking panics, government defaults, and social unrest. But transitions also create opportunities. Opportunities for those who understand what's happening and position themselves accordingly. The old system rewarded leverage, speculation, and financial engineering. The new system will reward savings, production, and ownership of real assets. The old system punished those who held physical gold and silver. The new system will reward them. The old system created wealth through credit expansion and asset price inflation. The new system will create wealth through productivity and scarcity. This morning, his yen crash is the first shot in a war between the old system and the new system, between paper and physical, between artificial and real. The war will be fought in currency markets, bond markets, commodity markets, and ultimately in the real economy, where real people make real decisions about what has value and what doesn't. The outcome isn't predetermined, but this morning gave us a clue about which side has momentum. When the Bank of Japan surrendered, they handed momentum to the forces of reality. to the markets that refuse to pretend that paper promises are equivalent to real assets, to the investors who understand that scarcity creates value and printing creates inflation, to the people who've been preparing for this transition instead of hoping it would never come. The transition is no longer coming. The transition has arrived.